Hello, and welcome to Track Your Dividends. In this video, we're going to be doing an analysis of Apple's stock, ticker symbol AAPL, for November of 2020. We're going to start by going over Apple's different business segments and how they've grown individually over the last couple of years. Then we'll quickly look into their dividends and dividend history. And finally, we will attempt to assign a fair value to Apple's stock to see if they're a good buy today. So, to begin, Apple splits its business up into 5 different segments. These segments are iPhone, Mac, iPad, Wearables, Home and Accessories, and Services. The iPhone, Mac, and iPad segments are pretty self-explanatory as to where the revenue for each segment comes from. For Apple's Wearables, Home, and Accessories segment, the revenue comes from sales of different wearable and home products such as the Apple Watch, AirPods, Beats, HomePods, and etc. Their services segment revenue comes from different services Apple provides, such as Apple Care, cloud services, different payment services such as Apple Pay and Apple Card, digital content like Apple TV, music, arcade, etc., and their advertising. Looking at Apple's revenue split by each segment for 2018 and 2019, we can see that the majority of Apple's revenue comes from their iPhone sales. However, throughout these 2 years, it's also notable that Apple's services and wearables, home, and accessories segment have both been growing at considerable rates, with the services segment increasing 3% from 15% in 2018 to 18% in 2019, and for the wearables segment growing 2% in the same time period. Looking at their revenue split by segment for 2020 now, we see this trend continue, with their iPhone segment only accounting for 50% of Apple's total revenue compared to 62% in 2018. Services also accounted for another 2% of revenue this year, jumping up to 20%, and the wearables increased again as well, accounting for 11% of Apple's revenue. Their iPad and Mac segments are also doing okay, however they aren't growing at the same rate as the services and wearables. We can further look into how each segment is growing individually by looking at exactly how much revenue is brought in. So, starting with the iPhone segment, we can see that since 2018, they've actually seen a decline in iPhone's revenue. And while this certainly isn't a good thing, it's to be expected, as we saw a similar pattern occur in 2015, where there was a spike in iPhone revenue and then it didn't continue to grow after that, and actually declined. This is likely due to the fact that people are starting to upgrade their phones less often. So, when a lot of people buy a new iPhone and there's a spike in the revenue, those same people are not likely to buy a new phone for at least 2 to 3 years, causing the next couple of iPhones released to see a drop in revenue. So again, while it's not great to see the iPhone segment's revenue decline like this, after the spikes we saw in 2018, the drops in 2019 and this year are to be expected, and we will likely see another increase in revenue next year when people upgrade their phones again, or at least for it to stay somewhat flat. Now, quickly looking into Apple's iPad and Mac revenue, both of these are doing okay in terms of growth. Neither segment has seen a substantial amount of growth, and within the past 5 years have been somewhat stagnant in their revenue. However, a definite positive for each segment is their recent growth over the past 2 years. This could be due to improvements Apple has made to each product and the software sent with them. Or these growth spurts could be due to a similar reason as the iPhones. With these 2 segments, it's a lot harder to tell, however, but we expect them to continue their slow growth over the coming years as Apple continues to improve the hardware and software. Now to get to the segments that have seen the most growth, starting with Apple's services segment. The services segment has seen a lot of growth, especially in the last 2 years, with it growing 26% in that time. The same goes for Apple's wearables segment, which has grown at a substantial rate over the past 5 years and does not appear to be stopping. Especially with Apple's year-by-year improvements to products like their AirPods, the growth in these 2 segments is incredibly good for Apple as a whole because it has diversified their revenue sources a significant amount. In particular, the growth Apple has seen with their services segment is amazing, since many of these services that account for the revenue in this segment are subscription services, which can be much more stable source of revenue compared to hardware sales. This is because the customer never actually owns the media in the service. They are instead paying monthly or yearly to get access to that media, whether it's movies or games. This means that unlike with Apple's iPhone revenue, where after a spike it will likely see a decline, since many people wouldn't be upgrading their phones, as long as people want access to, say, Apple Music or Apple TV, they will continue to pay the monthly or yearly subscription fee. Wearables and home accessories doesn't offer the same stability in revenue that the services segment does. However, its growth is still a very good sign as it further diversifies Apple's total revenue. So, looking at Apple's overall revenue growth, we can see that even with the iPhone segment's decline in revenue and both the Mac and iPad segments not seeing much growth, the services and wearables segments have seen enough growth combined for Apple's revenue to have grown 5% this year. As stated before, this is a very good thing for Apple moving forward, as they will have a more diversified revenue source, and shows that despite the iPhone segment's decline in revenue, Apple's other segments have already grown enough to make up for it and then some. We also expect that if Apple's iPhone revenue continues to follow a similar pattern to previous years, then whenever the next spike in iPhone revenue is, Apple's total revenue is likely to grow substantially as well, since that will be added on top of the growth of their other sectors. So, now that we have a good understanding of Apple's recent growth in revenue and an idea of how they might grow in the future, let's take a look at another benefit of Apple stock, their dividends. Starting with their dividends growth, we can see a visualization of this on this chart of their dividend history for the past 9 years, which is how long they've been consecutively growing their dividend. This isn't a great amount of time for consecutive dividend growth, however, it's not terrible either, so it's mainly a neutral point. Apple's yearly growth rate for their dividends is 6.25%, with a 5-year growth rate of around 10%. This is a very strong growth rate. However, looking at the chart, it's clear to see that the growth of their dividend has started to slow down. However, this isn't necessarily all bad. Looking at the same dividend history graph, but with Apple's earnings per share added in orange, we can see that over time, Apple's payout ratio has started to rise, and if they kept the dividend growth rate that they had, say, back in 2012 or 2013, they would have had an incredibly high payout ratio today and possibly struggled to pay out their dividends. However, by lowering the growth rate of their dividend, they also kept the payout ratio low and ensure that they can continue to grow their dividend for many years to come at the same 6% rate without raising their payout ratio to an unreasonable number. Apple's dividend currently pays 20 cents quarterly with a 0.69% dividend yield, and their forward annual payout for this year is around 82 cents. Okay, so now we understand where Apple's revenue comes from, their different business segments, and how they've grown in the last few years, and we have a good understanding of Apple's dividends and the growth of those. We are now ready and able to try and assign Apple's stock with a fair value. But first, let's see if we can predict whether or not Apple is going to be over or underpriced. Compared to other competing companies like Microsoft, Apple has a very similar price to earnings ratio. So that's not going to be very much help here. Okay, well, what else can we look at? Well, we can take a look at Apple's price to book value again with competing companies like Microsoft. And we can see that Apple's price to book value is much, much higher. This may indicate that Apple is overvalued at the moment. Alright, so now we can continue with the full valuation. We'll be using 2 different methods to try and be as accurate as possible. The first method will take into account Apple's dividends, while the second won't. However, the second will take into account Apple's debt. We can compare these 2 values and decide for ourselves what we think is a more fair value for the stock. Alright then, using the dividend discount formula for Apple's stock, their fair value comes out to around $87.74. Now, using the discount free cash flow method, we get a fair value of around $60. This may seem low, however, if we look deeper into how we get this value, we see that the discounted free cash flow method does take into account Apple's current and long-term debt. And if we look at a chart of their debt over the past 5 years, we can see that it has been growing and is now over $100 billion. So this is definitely something to think about when deciding if you're comfortable purchasing Apple stock. Considering both of the valuations we did, we believe a fair value for Apple stock likely lies around the $70 range. It mainly depends on your own personal safety margins and how you think the company will perform in the future. So, as we were able to predict by comparing Apple's price to book value with their competitors, Apple stock does seem to be quite overvalued now at around $118. What do you think though? Do you think this is a fair valuation? Let us know in the comments below, and don't forget to like and subscribe so you don't miss out on our next in-depth analysis video. Also, if you're interested in finding good dividend stocks for your portfolio, you can check out our last video where we went into the top 5 dividend stocks for November of 2020. If you decide to invest in any of those after watching that video, make sure you head over to our website, trackyourdividends.com, so you can easily keep track of them. Thanks for watching to the end of the video, and we'll see you in the next one.